In this video, we are going to do an introduction on bonds. So a corporate bond is a corporation's written pledge to repay a specified amount of money with interest. If it sounds like a loan, that definition, that is because it is a loan. So a bond is a way that corporations borrow money. They can borrow money in commercial loans, the ones that are more standard as any other loan that you know, but they can also sell bonds to the public. This way, you investor that is not a financial institution like a bank can lend money to a corporation without having to be a financial institution like a bank. There's some regulation and details about the bond. That is in order to protect the investor, or at least have the investor informed of what the situation is like. And then the investor can purchase bonds. And what they are doing effectively is lending money to the corporation. Face value, you may hear that a lot with bonds, is the dollar amount that the bondholder receive at the bond's maturity date. So face value, present value, and par value, they all mean the same thing. Is the actual number on the bond of the money that will be received when the maturity date hits. So bondholders receive interest payments, usually every 6 months at the stated interest rate. So we call it the coupon rate. Now the coupon rate will be reported on the annual basis. But if you get it every 6 months, then you get half in 6 months and the other half at the end of the year. Now, not all bonds make interest payments, and the ones that do, not all of them are every 6 months. You will know that before buying the bond. It will tell you what the conditions are. And those conditions, which are the legal conditions, are describing what they call the bond indenture. The bond indenture, look at it as the contract. That's where all the details are specified. The coupon rate, those are the interest rate that you're going to receive. The face value, the maturity date, and a lot of other details that go with it. A trustee is a financially independent firm that acts as the bondholder's representative. That is becoming less and less common because people have access to buy bonds in so many different ways. And well, I shouldn't say less common, but it used to be the norm. It doesn't have to be that. Let's say it that way better. To get funds for major purchases, that's why the corporations sell bonds. They need to raise capital to fund ongoing business activities. So if they need to continue operation, they need some cash, they can sell some bonds, borrow some money, just like any other business would do with a commercial loan. When it is difficult or impossible to sell stock, a company at any given time can issue more stock in order to collect capital, but it is not always beneficial for the company to do so. So that is when they say difficult or impossible to sell stock. So you need to raise capital in a different way. To improve financial leverage. Financial leverage is when a company borrows money to depend less of the investor money. And in turn, when appropriately applied and everything works out as planned, then you actually end up with a higher return on your investment. So that's what they call leverage. So sometimes companies start with very low debt and they're not taking full advantage of the capacity to use financial leverage. So they just borrow more money to then have more access to capital in a way that improves the return on investment. However, there's an optimal point. If you borrow too much money, then that starts going down, that benefit. So it's not always as simple as just borrow more money. Interest paid to bondholders is a tax-deductible business expense that can be used to reduce the federal and state taxes corporations must pay. So when a company raises capital through equity, whatever return on investment, like dividends and all that, are not tax deductible to the company. They start to pay taxes on their income. However, borrowing money and the interest paid on that money, that is a business expense. So the interest paid can be tax deductible. Types of bonds. There are a lot of different types of bonds. We only gonna mention some of the more popular ones. Debenture bonds. Most corporate bonds are debenture bonds, unsecured, backed only by the reputation of the issuing corporation. Unsecured is a key word here. What it means is like a signature loan. You are lending money to the company, and based on the reputation, you just, hoping that they're going to pay your interest payments and your face value at the end without any collateral, let's put it that way. However, there is still some protections with the assets of the company by law. If the company was to not pay their debt holders, the debt holders can trigger bankruptcy to the company, meaning liquidation of assets in order to get their money back. There is some ways to do that. So even in secured, you would have to go through the tedious process of the bankruptcy court. But even unsecured, there are ways to still try to get your money because debt holders always get paid first. Mortgage bonds, a corporate bond that is secured by various assets of the issuing firm, usually real estate. And now we jump into where the actual bond is tied up to the real estate assets directly. Interest rate is lower because it is secured by collateral and corporate assets. What that means is that if you buy a mortgage bond because it's a little safer, the interest you're going to collect on that loan, on that bond, it's inherently going to be lower than what you will get here because it's a higher risk here. Subordinated debenture bonds. So bonds, and let's focus on the word subordinated. Bonds have classifications senior and junior being the same as subordinated. What it means is that if or when payments are being made to the bondholders and interest and maturity and face value, the senior bonds start getting paid first. They get their money first. And then as money is available, then it goes down the line. Now, this is typically not an issue if the company always has sufficient cash to make the payments. It's when a company is financially distressed or low in cash or has liquidity issues that the subordinated bonds have to start worrying a little bit because senior bonds will get paid first. And it's a debenture, then there's nothing to secure it. The only other way is to try to go through bankruptcy. And even then in bankruptcy, the seniors get paid first. So because there's more risk there, a subordinated bond will have a higher interest rate than a senior bond, or it should. Convertible bonds, a special kind of corporate bond that can be exchanged at the owner's option for a specified number of shares of the corporation's common stock. So you started by buying a bond. Let's say things changed. Then it can be converted to stock, and then you don't receive that interest payment anymore, but now you have stocks and you can actually earn a higher return because they typically return higher values than you would with a bond. But you also then share the risk. The risk is higher. A convertible corporate note is a legal debt convertible to shares of common stock at the investor's option. So notes, and we'll talk about the definition a little later. It's just another type of note is another word for a type of loan as well, but it operates the same as a convertible bond. High yield bond. High yield, just what it sounds like, is a bond that yields a higher return on your investment. However, as mentioned before, higher returns come with higher risk. So these are companies that represent a higher risk. So you are understanding that you have a higher chance of not getting your money back or not getting your payments, and even default. That'll be the formal way to say it. The default risk is higher. So therefore you get a higher return. And that's why they call them often as junk bonds. It's just a nickname, as in you are investing in companies that either don't have enough reputation yet or still at a very high risk or on a high risk path. Provisions for repayment. Some more here. We got the call feature. Corporations can call in or buy back outstanding bonds from current bond holders before the maturity date. Now, not all bonds have this. You will know ahead of time before you buy the bond. In the indenture will specify if this is a callable bond. What it means, or what it means to the investor, this is a scenario. You have a bond that is paying 10% interest every year. But then the market conditions change and companies can access capital, more bonds or commercial loans at, let's say, 5%. So they wouldn't want to continue paying you 10% if they can just move the debt to a 5% a debt. It's cheaper. It's better. So what they'll do, if there's a call feature, they'll buy the bond back from you. The price and the mechanism and all that is calculated, and it's already is known ahead of time. How much would it be depending on how long you held the bond? But what they're doing is removing that higher interest rate debt in order to engage in a lower debt. Now, because that represents a higher risk to the investor, typically bonds with a call feature upfront will be paying a little bit more interest. How many years they have into the callable, that depends on the indenture, but that you will know ahead of time. So why would investors purchase corporate bonds? Variety of reasons. Let's go over a few of them. Bonds are another way to use asset allocation to diversify your investment portfolio. Diversification, just in general. The more you have different type of assets and different type of investments, the more diversified your portfolio is. That just means you're lowering your risk while still receiving an average return, a suitable average return. Investors consider government and corporate bonds a safer investment when compared to stocks, because a bond must be repaid at maturity. And if they don't pay, then you can trigger bankruptcy and still get some money through the liquidation of assets. Bonds may provide more growth and income potential than other conservative options. What we mean, not more growth and income potential than, let's say, stocks, but other conservative options, meaning money markets, CDs, and other forms of investment that have a much lower rate. Interest income. This is a reason to do it too. In other videos, we have discussed how some investors choose stock that pay dividends and some investors don't. And it has to do with the need or desire for regular income out of the investment. So because bonds typically pay interest payments, not all, but they do, you can easily then buy bonds at a lower risk and receive that periodic influx of cash. Investors receive interest usually every 6 months. The dollar amount of interest is computed by multiplying the interest rate by the face value of the bond. You take the coupon rate times the face value. A few more vocabulary terms here. Registered bond. Interest checks are mailed directly to the bondholder of record. Now, believe it or not, some people still prefer things mailed, but that's disappearing more and more. Everybody does online banking and stuff like that, but it's the same concept. If you hear the term registered coupon bond, registered for the principal only, interest checks are paid to the coupon holder. And that's if there's a separation between the actual bond itself and the coupon. Bearer bond may still be issued by foreign countries, but not the US. Bearer bond used to actually be a physical piece of paper you had in your hand. But like that mailing checks point that I brought up, that everything is done electronically now, in the US, it's gone. The bearer bond, it doesn't exist anymore. And it has to do with technology and everything being done online. Dollar appreciation of bond value and bond repayment and maturity. So there's another way you can make money out of bonds, not just the interest payments. Investor may be able to sell the bond at a higher price if the interest rate on the bond is higher than the interest rate of new bonds. That means, and this is the main piece here, that first bullet. Generally speaking, If interest rates go up in the market, the value of the current bonds out there is going to go down. And vice versa. If the interest rates in the market, the new rates, the new bonds coming out are going to be lower than the ones already outstanding, then the price of those bonds, the outstanding one with a higher interest rate, the price is going to go up. Here's the logic. If the interest rates today is 10% and you buy bonds at 10%, some time goes by and the interest rates go lower. So new bonds coming out at 6% because that's what the market is dictating at the time. So your bond has 10%. So your bond has more value than those new bonds coming out at 6%. So since the 10% and the 6% cannot change, what you do change is the price of the bond. You can sell your bond for capital gain. People will pay you more for the bond because it's paying more than the 6% of the other bonds are. And the same is true on the opposite. If interest rates, the new ones start going up, your bond becomes less valuable. Now, you still get the interest payment and you still get the face value at the end if you hold on to the bond. It's if you decide to trade it before maturity date that relationship between interest and price that I just spoke about kicks in. Dollar appreciation of bond value. Yield is expected rate of return earned by an investor who holds the bond for a stated period of time, usually 12 months. It's not that you necessarily hold it for 12 months. What we're saying is it is calculated on the yearly basis. When you calculate it so you can compare things, you want to calculate on a yearly basis. Yield, it's not the same as the coupon rate or the interest rate you're earning from the bond. What happens is, as we mentioned a moment ago, the price of the bond can go up or down. So when you do a comparison of the coupon rate or the interest rates of the bond you have to the current ones in the market, the price is going to move. So the yield, when you calculate it, takes into account that difference of interest rates and the impact on price. And then it gives you the actual return that you'll be getting that accounts for the interest rates coming in, the interest payments coming in, and if you can sell the bond for more or less of the face value. So there could be a capital gain or loss there. And then it gives you an actual percentage saying, well, this is what you're really getting, accounting for capital gains and interest payments. Bond leverage is a strategy to buy bonds with different maturities to balance risk and return. So right, you can buy bonds 1 year, 5 years, 10 years, 20 years. And what it is because the difference in the changes in interest rates and the difference in interest rates for those bonds, you can average out a certain amount because, well, some of them might go up or down. You're avoiding interest rate risk and other types of risk. So it's like it falls under diversification of your bonds, if you don't look at it that way. The mechanics of a bond transaction. Most bonds sold through full service brokerage firms, discount broker firms, or the internet. So it's easy to have access to bonds. You can do it online. Now it is. Before, this always had to be through some kind of broker in between, like an actual person. Now everything can be done online. Lower commissions for discount brokerage firms and internet, as usual. If you just use online automated stuff, it's going to be cheaper. If you're using an actual person, they'll have fees. Brokerage firms charge a commission when you buy a bond and when you sell a bond. There will be a fee or a commission at any given time, somewhere, somehow. How and when and where it's charged, it just varies. A government bond. A government bond is a written pledge of a government or municipality to repay a specified sum of money with interest used to finance costs of government. It's still a bond. It's just that instead of a corporation, it's the government. Now, because it's the government, they are considered to be lower risk, especially the federal ones, because as of right now and forever, and no expectation for that to change, the United States at the federal level guarantees that you will get your interest payments and maturity regardless of the situation of the economy. But that's only in the federal level. States cannot do that because states cannot print money. States have to work on a balanced budget. But then the state ones, state and below municipalities, they have tax breaks. So it gives you a different type of a return on your investment, improving the risk return situation. But it's still you lending money to the government instead of a corporation. It's still a loan. U.S. Treasury bills and notes. This is just some vocabulary. Of course, some of these numbers change because, the economy changes over time. Treasury bills right now, you may see them at $100 minimum. Those maturity dates are typically 4 weeks, 13 weeks, 26 weeks, or 52 weeks. So the year less. Sold at a discount. This is what this means. These treasury bills do not have an interest payment. What you do is you buy it for a lower amount, and then at the end of the period, the maturity, when it hits, then you get the face value. So the face value is $100. This is an example. You buy it for 90, and then at the end of the whatever weeks it is, you get the $100. And that's why I say sold at a discount of the face value. But that's because you're not going to get the interest payment. Current yield, discount amount over the purchase price. You divide those two, and that's how much that's your return, your percentage, your rate of return. Treasury notes, these are also known as T-notes, typically $100. And here we're looking at 2, 3, 5, 7, and 10 years. These typically have the interest payment paid every 6 months. So they're not necessarily sold at a discount. Then you have the U.S. Treasury bonds, same, a minimum of $100. These are 30 years. These are the long-term ones. Interest rates are generally higher than those of T-bills and T-notes, and the reason is because it's so long of a period, the risk of interest rates changing on you is higher. So you get a little bit of premium for that. Same thing, interest paid every 6 months. Held into maturity or sold before maturity, meaning you can trade them. And all of them you can trade. It's just that they almost have a shorter time span, but you can always sell your bonds at any given time. Municipal bonds. These are still government ones that we're talking about now, or back to it. And these are municipalities. It's just another way. Anything that is not federal, they call it munis. So debt security issued by a state or local government. So the state level or below, county, city, you name it, those are what they call munis, for short for municipal bond. Everything above state level will be the federal ones, which are guaranteed. It says here that some states guarantee payments on selected securities, but is not the same as when the federal government guarantees it. When the federal government guarantees it, the government itself backs it up and puts the money. The way the states can guarantee it is because they'll have private insurance that covers the bond in case the state runs low in cash. And that's why it says here that municipal bonds are not as safe as U.S. Treasury or federal agencies. Now, they're very low risk. Don't take me wrong. It's just not the same when the federal government can guarantee it and, in other words, print more money if they have to. But you will get your payment. Bond ratings. Look at bond ratings like credit scores. You familiar with a credit score? Is a number in the hundreds, and the lower the credit score, the worse the credit reputation. The higher the credit score, the better your credit reputation. So bond ratings are pretty much the same thing, but they use letters. There are different companies that rate them. The two big ones are Moody's and Standard & Poor's Corporation, but they're not the only ones. And what you will see is between A and D. So, and it could be multiple A. So AAA, AA, A. So AAA is the top. That's the best score you can get, the best rating. AA is still really, really good. It's just not AAA. And A, still investment grade. But and then you go down, triple B, double B, single B, et cetera. And you can move your way down. And then you got all the way down to D. And and just the way it sounds. The lower the letter, the lower the reputation. So what happens is, if you have a low rating, you're going to have to offer higher interest rates. And now we're going back to the junk bonds that we mentioned earlier, or the high yield bonds. These are companies that are high risk because they have a low rating. But then if it works, you get much higher interest payments and return on your investment on those bonds. That's it for that video. See you on the next one.